Lisa, I want to go to that Econ 101 concept of elasticity, and that's the dynamic of yield. We're in a new yield regime, supposedly. When you see the movement of yield, full faith and credit day to day, is it a new elasticity or not?
You know, it's funny. Yields are as low as they are. People are doing their 2021 forecast saying, where can things go from here in the U.S.? And we did some work looking at European yields. Obviously, we started this year at much, much lower yields, and yet Bund delivered returns of plus 20% year to date. So, you know, you look at a very low yield environment and you say, is there any value left? And the answer is, well, it depends on where we're going to go from here. Certainly, there's a tremendous amount of liquidity in the system, a lot of demand, and that's particularly true in fixed income markets in the U.S., where there's still some positive real yielding assets out there.
So this is the conundrum right now. I mean, people are looking at $17 trillion of negative yielding debt, a record high globally. We're looking at yields that are historically low in the United States, even as we look to increase deficits and spend going forward. And you have Morgan Stanley coming out and saying this can't last. People are optimistic about the future, and you're going to see yields rise. It's going to be tough to be in duration. Do you agree, or do you think that they have it wrong and that the overhang of debt is just going to keep growth so slow that yields here make sense?
I mean, that's the question. I mean, I think in the near term, we're certainly going to be grappling with the virus and you know, hospitalization rates rising and how that's going to affect the economic data. But if we take a longer term perspective, we have a pretty supportive market, right? Central banks are certainly not going to get in the way. We're still looking at more fiscal stimulus in various parts of the world, including in the U.S., probably in January. So, you know, it is a very supportive environment for financial assets. If you take a longer term look, I think that we are in a cyclical recovery phase, and we will start to see yields move a little bit higher from where we are now. But, you know, when you look out even longer term, we still are dealing with very, very large debt burdens, and it's hard to see an environment where yields get aggressively higher from where they are.
Lisa, what was the lesson from spring?
The lesson from spring was follow valuations, right? If you think about where we started this year in credit markets, for example, we came into it in the 10th decile or so. In other words, credit spreads were as tight as they've been for a very, very long time. And if you came into this year listening to that, you were relatively low on risk. And that set you up perfectly for what we saw in March and April, with spreads blowing out to basically their 90th percentile, 95th percentile over a long-term range. And, you know, if you were able to take advantage of that, you did quite well this year. And now we're kind of past that easy period in markets where, if you wanted to call it easy, where the easy money has been made. And now it's about getting the industries right, getting the issuers right, looking at sectors that are going to benefit from the vaccine going forward. And I think that there still are opportunities out there, but again, you have to let valuations be your guide.
Let me tell you, nothing felt easy about spring, and I'm sure it wasn't easy for you either, Lisa. The reason I asked this question is because I think many people don't think we will see spreads blow out again. There is this comfort with the Fed being in the market. There is this belief that so many people are conditioned by what happened after spring. Why step out? Because you're going to miss out on the levels. They're just going to go tighter. And I just wonder if that's the right lesson to take away from the experience of spring.
Yeah, historically, if you look back over time, the starting point certainly matters. And now I take your point, John, that, you know, perhaps we're in a regime now where spreads can move to the tighter end of their range and stay there for a bit longer. So you have to adjust your valuation barometer a bit. But at the end of the day, spreads are mean reverting. You are not, when you're not being paid to take risk, you shouldn't be doing it. That's certainly how the approach that we've taken to managing money, and certainly what we'll do going forward. So we will listen to what the price tells us. When there's not opportunity, we'll diversify away from corporate credit. We'll look at other areas like agency MBS. We're looking at things like taxable municipal bonds, where you still see strong fundamentals in certain parts of the market. and attractive valuations.
All right. Well, in credit, what doesn't look expensive historically? I mean, I'm looking right now at high-yield bonds. They're yielding 4.8% at a time when we really do have slow growth expectations ahead.
So I think there's a couple of pockets. So first of all, you have the COVID-related sectors that are still trading cheap on an aggregate basis. There are companies within those sectors that are positioned to withstand the next 6 months of volatility. They have the cash flow, they have the balance sheet cash to insulate them, and they'll be able to make it through this period, and then they'll be poised to benefit from the cyclical recovery that we'll see on the other side. I think there's issuers within the aircraft manufacturing space, for example, within travel, within tourism that fit that bill. I mentioned the municipal space. There are certainly universities are going to benefit. Airports are going to benefit when we come out on the other side of this. You need to look for the right issuers within these sectors. So airports, for example, with lots of cash on hand, with reserves on hand. But if you can find those names, and there are many of them, then I think you'll be poised to benefit on the other side of this crisis.
Lisa, John Templeton years ago predicted there'll be a shortage of bonds. I would suggest the greatest surprise as we end this nuts year is the idea of the expansion of debt, and yet we still feel there's a shortage of bonds. Is there a shortage of bonds?
It sort of depends on how you look at it, I suppose. But certainly yields would tell you, which continue to amaze us, right, that there's still a tremendous amount of demand out there. I mean, I focus primarily on the U.S. markets, and overseas investors still benefit from buying U.S. dollar-denominated yields relative to their own home markets. So from that perspective, I suppose you can say, yes, there's not enough of them, because if there were, we'd see yields moving higher and not lower, despite debt loads increasing across the board.